Well, we certainly have a heater, a fastball for you today, folks. And I think that baseball analogy is appropriate because it is October and baseball playoffs are underway. We're excited to have Dr. David Kelly, who is the Chief Global Strategist for JP Morgan Asset Management. He provides valuable insight and perspectives to thousands of financial advisors and their clients. Certainly has a unique ability to distill down information of what's happening in the economy, in the markets, why it's important, and just providing clarity to people. I'll put it this way. If you followed the markets, you've probably heard him in his commentary. You've read his commentary. So Dr. David Kelly, we certainly appreciate you being with us today.
I'm very glad to be here.
Yeah, we're glad to have you. We're excited about this conversation. Let's start out with the big picture. I mean, worldwide, there's been a lot of things happening economically, and I think translating this into what do we do with this type of information has been probably the biggest issue just in the media. It's so polarized right now where I think people are taking on a lot of extreme views. We want to moderate that with here's where we think things are going to go. What is your feel on what's happening right now with President Trump and the tariff campaign that he started in April that is still not resolved up to this point?
Well, I think first of all, you should start with, well, where was the economy going into this? And the sort of good news and bad news in the economy. I think of the American economy, it's kind of like a healthy tortoise. It's not very fast. It's not very hot, but it does move forward pretty steadily. And what I think has been surprising all year is that despite a lot of policy change in Washington, a lot of things that people could have been scared about, the tortoise is moving forward. So the economy is still growing. I think it'll probably grow a little bit more slowly going forward. And we can talk about that. But overall, the economy it's doing okay. And what's really interesting is the economy is kind of moving forward in a pretty boring way. And that's on one hand. On the other hand, a lot of individuals in the economy are really being held back here and feel pretty miserable about the state of the country and the economy. And then the third thing to look at the markets. The markets are having a great year, and they had two great years before this. So you sort of got gloom and sentiment, boredom in terms of how the economy itself is behaving, and you've got champagne and sparkles when it comes to the market. I think that the real challenge here is just to make sense of all of that.
Deceiving at best is really what it is to the standard investor, just trying to understand and how to digest the information, the polarization. Like you said, the economy's chugging along. If we were to remove certain components of the property, or if we were to remove certain components of this economic activity that we're seeing right now, I don't know that we would be doing as well as what we're reporting. Like, for example, there's been a huge push with semiconductors and AI, just the notion that there's a lot of build out going on, and how much of that is actually affecting these good numbers or making it look good.
Well, I think it's making it good. I mean, it is helping. So it's kind of a mixed picture. You are seeing a lot of capital spending, a lot of building out of data centers and the electricity grid and chip purchases for the AI revolution. And it reminds me very much of the late 1990s when we all were getting very excited for the first time about the internet. And I think AI will probably in the end be just as transformational as the internet itself was. That certainly is helping the economy move forward. That's one thing. A second thing that's helping the economy move forward is we've got these huge stock market gains over the last, 3 years, really. And that has made a lot of people, particularly at the top of the income spectrum, people who had a lot of money in 401ks and money in their own personal stock holdings to start with, they're doing very well. But on the other hand, you've got slow demographics. I think they sort of crack down immigration, but also the drop in immigration coming from other countries, normal legal immigration, that is really squeezing our population, our labor supply. So suddenly it's getting harder and harder to find good people to work for you. That's slowing the economy down. The housing market is not really going anywhere because people just can't afford to buy the houses. And of course, government spending, particularly federal government spending, has been cut back as part of the policies of the new administration. And then you do have all the uncertainty about the tariffs, which are affecting a lot of businesses. But American businesses generally try to shrug off as much of this as they can and just move forward. And that's sort of mixed together. It's not great, but it's not terrible either. It's just an economy moving forward despite a lot of distractions and bombarding by different issues coming out of Washington.
A lot of components, a lot of competing pieces as well. And I guess that was the point, which is you're looking at the spending that these companies are making, the investment into AI is enough for consumers to maybe take a step back and say, well, why are they doing this? What is their opportunity out there? Meaning, is this a something that we're going to see a new top in like we had seen at the top of the internet tech boom? And my feel on this one is no, we just got to continue to watch this. It's a race toward a technology that we're competing against other nations for, and there's some strategic purpose to it as well. And that this economy will probably continue to roll on. And so my feel on that one is just do the same. I wouldn't overweight to all that stuff. I just understand the big environment.
Well, yeah, but I mean, having said that, people are very excited about it, and you have to be, you have to take a deep breath and don't put all your chips in any one of these baskets, and don't put all your chips in the chip basket either.
Well, Dr. Kelly, on that topic of AI, obviously that has been one of the biggest contributors of market growth, enthusiasm for investors. You look at the, what you could argue is over-concentration, which I'd like to get your take on, is when you look at, let's say, the S&P 500, that most of the gains that we've seen over the past few years have been attributed to just a handful of companies. I mean, do you have concerns around the sustainability of that? And is it fair to lean on historical context, given the fact that we're talking about technologies when we talk about AI, quantum computing, something that could be revolutionary from the standpoint of, I mean, how we look at day-to-day and labor and things like that. I mean, I know there's a few different angles that I brought up there, but what's your take on that?
Well, I think you should always, learn the lessons of history, but don't over-apply them, because this economy is evolving and every boom is a little bit different from other ones. So what we're seeing right now is I think a lot of companies, a lot of individuals see the opportunity in AI, because if these computers get smarter and smarter, there are a lot of service sector jobs in particular where, instead of calling up a call agent who's located in India, you end up just talking to a computer, and in theory, the computer is going to be smarter. However, I will tell you that my personal experience of, how many times have you yelled into a phone saying agent, because the thing that was supposed to be so smart at the other end is just sending you down blind alleys. So the day I don't have to yell agent, I know AI is working, but that day hasn't come yet. And equally, I think no company wants to say they don't have an AI plan. Now, no self-respecting CEO could go on an earnings call and say, well, we don't think AI is really here yet, so we're not going to worry about it. No, everybody's got to be an AI enthusiast. That's table stakes for US corporate management. But that means that a lot of corporations are investing in AI and trying it out without really knowing how it could improve their productivity. I mean, people are always sending me articles. Hey, I put this article together. I used our large language model, and they managed to take 96 pages down to 8 bullet points. You know what? I can't even read the 8 bullet points. They're so boring. And I'm not sure that that's really enhancing productivity. I think it will eventually. Particularly when you can marry AI with robotics. If you can tell your AI robot, please go out and mow the lawn, but only on Tuesday if it's not raining, and it figures it out and you don't have to worry about it anymore, that's when it makes a difference. And we're not that far away from that, but I think we're not there yet.
Indeed. I see the opportunity with this AI as being revolutionary. I'm excited about it as well, not being afraid of it. Instead, just trying to learn about it, staying away from some of the scare tactics that is a large part of this, but seeing the opportunity that's ahead. Now, we're talking about the replacement in theory of American jobs, of a lot of data processing jobs, things like that. And we understand that risk, and that's why we would repurpose those people in the economy. I think the real message here is that we are seeing companies still investing in the future economy, meaning they're optimistic, they're spending large amounts of money, and that the optimism is good. Where we seem to take away some optimism, you may have some comments about this, is the Federal Reserve having control over rates, at least perceptually from the consumer standpoint, and this political fight that is going on from the Oval Office and having some influence of what's going on with the Fed. How do you see this playing out, and what do you think will happen with the Federal Reserve once they finally get us down to a base rate that they feel comfortable with?
Well, I think Federal Reserve independence is very important. The Federal Reserve was founded in 1913, and it's always been independent. And it's been independent from the federal government for a very good reason. I think Milton Friedman used to say, the problem with monetary stimulus. I don't know if you use exactly that phrase, but the problem with it is it's kind of like alcohol. All the good effects come first, and all the bad effects come later. And the time frames of politics are very short. So of course, all the politicians will want easy money, even if it causes inflation down the road, or even if it causes asset bubbles. And that's why you do need to have an independent Fed who can push back at Congress or the administration or whomever and say, look, we're going to make these decisions based on what we think is right for the American economy, the American people in the long run. And while I've disagreed many times with with individual decisions the Federal Reserve has made, on average, I think they've done okay, and I think it's very important that I just don't want to put I don't want to put the people who've been managing fiscal policies so well and managing the budgets so well over the years in charge of monetary policy too. The day they run a balanced budget, that's when I'll trust them with it. But I'm not going to trust them yet.
Well, I mean, that's another point of concern that, I mean, I hear a lot is that the deficit spending, the government spending, and obviously, I mean, I don't care what side you're on. I mean, everyone likes to spend money for their objectives and their endeavors. And that's a big concern that we see with clients at the individual level. You see all this debt, and is there concern around the US dollar, I guess the safety of U.S. debt, the credit worthiness. Obviously, we've seen rating agencies come out and have their, picking apart certain aspects of this. Meaning, do you see problems, or does this need to get shored up sooner rather than later? Like, does there need to be a plan based on the route that we've been taking over these past few years?
Well, there does need to be a plan, and there probably won't be a plan. And again, I appreciate you. Let's try to keep clear of the politics on this, because this is. Ultimately, it's the decision of the American people who they're going to elect. And for years, we have not elected anybody who says that they are going to raise taxes and cut spending in order to actually balance the budget, and that's the platform they're running on. None of those people live in Washington. We send none of them to Washington. So it's either people who are yelling that the other guy wants to raise your taxes, the other person wants to cut your health care. Those are the people we send to Washington, and those people don't fix the budget. So it is a growing problem. It was growing when, at the start of this new administration, and the administration has done sort of two things which have kind of offset each other. One is they've extended the tax cuts from 2017 and introduced a whole new set of tax cuts, which the temporary going through 2028, I think they'll be made permanent too. So that's made the deficit worse. On the other hand, they brought in a lot of tariff revenue. I mean, the tariff revenue is running at $30 billion a month now, and that's $360 billion a year. That's a fair offset to that. So the deficit situation isn't any better or any worse than it was before, but it is, the trend is getting worse. We're going from a debt which is equal to 100% of GDP, which is the highest since World War II, right now, to about 120% of GDP by 2034. Even if we don't pass some further tax cuts or further spending plans, and we probably will. So it's going the wrong direction. I still don't think there's a near-term crash coming. I can't quite see that yet. I think that people are still quite willing to buy U.S. government bonds, but if we were to lose Fed independence, I would worry about that. Or if there was some other great political disruption, I'd worry about that. But also, it's one of those risks which, probably won't get you near term, but there is a way to hedge against it. Because if this is going to go wrong, well, what's going to happen? The U.S. dollar is going to go down, and maybe in other places where the Germans care more about debt than we do, or the Swiss. So maybe there are places that do that. We don't have as much of a government debt problem, and you can spread your money around a little bit there. So I think people are very a lot of people have just got all their money in U.S. assets, and I think if you're worried about debt, it's a reason to think about not going to cash. It's a reason to think about spreading your investments around the world.
Dr. David Kelly joining us here, Chief Global Strategist, JP Morgan Asset Management. We're super appreciating this time with you. We want to make good use of it. Now, when we're looking at managing money, we're obviously being pinged a lot with cryptocurrencies, and should we have more access to those? Is that part of the hedge that you're talking about as well, from maybe a dollar that would have lower credibility in the worldwide scene?
Not cryptocurrencies, no. But I'll give you my personal view on this. I don't like Bitcoin or cryptocurrencies. And the reason I don't is because there's nothing behind these assets. I mean, yes, there are 21 million Bitcoins out there, or there's a maximum that can be, but what's backing them? I mean, there's no asset backing them, and they only maintain a value or go up in value because people want to buy them. But they can't really be used as a currency either. I mean, they call them cryptocurrencies, but the one thing you need about a currency is it needs to be boring and stable. You need to know that it's worth exactly, essentially
Yeah.
the same thing 2 weeks from now as it's worth today. And you don't know that about Bitcoin. So it doesn't actually function as a currency. So what it really is a focus for speculation. And there are reasons why, there are political reasons and there are also institutional reasons, taxation reasons why Bitcoin has tended to go up. But in the end, it reminds me, back in the 19th century, they had a lot of wildcat banks in America. And these were anybody get a banking license, and you could have, the sort of the third bank of Sleepy Gulch, Wyoming, or whatever. And it would, but these banks they used to put the banks themselves in faraway locations, and there was nothing actually in the vault. But what they would do is the one thing you need in one of these small regional banks, is you need to have a very good calligrapher, because they could draw really beautiful notes. And so people have got collected old notes from banknotes from the 1840s, but they would send these notes out to the world and it would say that this bank promises to pay you, $10 in gold or whatever. And the whole point was, so long as it stayed out circulating around, there's no problem. If it ever came back to the bank, there was nothing in the vault.
Right.
And to me, it's very analogous to cryptocurrency, because cryptography is fascinating, and it's really fascinating how the prime numbers and all this stuff, and the amount of electricity required to crack the code, and I think it's great. But it's basically just the decoration on an empty box. There's nothing in there, that's what I have a problem with.
Yeah.
It is actually a perfect example of a non-government backed fiat currency. So if the fiat currency is something government backed, this one's worse. It's not even government backed. It's just consumer perception value, but it's also a good example of credit, which is if there's perceived value in there, that if it was going to have some value to somebody else, then there's their good credibility. And that's why it's getting so much attention. But just like you said, there's no processing speed times that can actually compete with the Visa and MasterCard systems yet. When that happens, maybe we can call it a currency. We're referring to crypto as a digital asset. That's it. There's no other way for us to describe it.
Well, that's right. And I mean, I think it's important to think about this, because I was talking with some of our internal guys because we do have blockchain technology we use within JP Morgan, and there are certain transactions around the world which just make sense to use blockchain technology, but we keep it within what we call a walled garden, where we're using all the legal protections and the know your customer rules that we'd have to apply to any other transaction. And half the advantage of Bitcoin is being able to avoid that stuff. The other advantage is there are some things in terms of international transactions where it's a little clunky, or even domestic transactions where you send a wire and you don't know, is it going to show up at 11 o'clock in the morning the next day or 2 o'clock? And that shouldn't be the case. I mean, we should be able to speed that up, but that's not a very difficult technological problem. But so I think there are ways of using blockchain technology. Okay. But the real issue is your asset backed by something? And, if we have a stable coin in the United States, in JP Morgan, which is JP Morgan digital dollar, so to speak, you can convert it anytime you want into a US dollar. Now, stable coins also offer that. A lot of people are issuing stable coins now, and we just saw some legislation passed which said, well, you can issue a stable coin, and by the way, they have to be 100% backed by treasuries, and by the way, they can't pay any interest, which is a great deal for the issuers.
Yeah.
Because it's kind of like one of those gift cards your least favorite aunt gives you, which says, the aunt paid $100 to the sporting goods store, and they've given it to you, except there aren't any actual outlets of that sporting goods store in your town. So you're looking at this card, which costs your aunt $100, worth $100 to you, but you can't really use it. Yeah. And meanwhile, the issuers are busy making interest off the money that they took from your aunt. So it's not a great deal for a consumer. So no, I would not think. I'm quite willing for Bitcoin to go up or down or whatever. Right. I just don't want to participate. But the one other thing that I think is important for people to realize is just because something goes up doesn't mean that that it's got real value. It's as Lincoln said, you can fool some of the people some of the time. And when it comes to financial assets, that's all you actually need. You don't need everybody to believe in it. You just need a few people to believe in it, and a mechanism why a lot of people just can't sell because of capital gains tax, and suddenly you've got this bubble asset. And I think that's kind of what you got here.
I think that's exactly what we have here. And when I said, could it be used as a hedge? It's like, no, that's actually the worst hedge you could possibly have because it literally is unpredictable and it's crowd driven and it doesn't have the credibility. It's not a hedge.
That's right. Exactly. I mean,
asset at best.
Exactly. To be nerdy and statistical about it, the idea of a hedge is it's got something that's supposed to zig in a predictable way when the other thing zags.
Right.
We don't know. We know what it's going to. It may zig and zag, but it's not in relation to anything else in financial markets.
Well, then that would lead me to gold. Is gold still a hedge?
Out of my mouth.
Because it should be zagging when something else is zigging. We don't see that. We're seeing them work in tandem.
Yes, and gold is. I used to not like gold as an asset, and I'm still not a huge fan. But I think it's. But I will say this for gold, that there is a genuinely limited supply of gold. I mean, I could come up with a Mitcoin or a Zitcoin or a David coin, which is actually my favorite. I think I may launch out at some stage the Dr. Dave coin, make a fortune off.
I love it.
But gold, there, not only does it have some uses in chemistry and obviously in jewelry and a long history in central banking. Millennia of value to the human race. But short of nuclear fusion, you can't produce any more, or fission or fusion, I suppose, with gold. I don't know how difficult that is, but I assume it's pretty difficult. So there is a limited supply, and it does have a long tradition. So I feel better about that because there's some uses for it. But still, it's rallying right now because there's a lot of liquidity, which is just causing bubbles to form all over the place. But if you go back to 1980, it's basically matched inflation. It has these occasional spurts and then it just sits there for a while, doesn't do anything. And almost every other long-term asset's gone up relative to inflation. So, people talk about something being as good as gold. I can't think actually of any long-term financial asset that's been as bad as gold.
Thank you for saying that. I can't tell you how many times it's been rubbed in by my clients. They'll be like, see, gold finally went up. Yeah, it was once in a decade. You got it. I'm so glad for you. Let's carry on.
Like a stopped clock is right twice a day.
Yep, there you go. Right. So, Brian, you took the words out of my mouth. I wanted to get your take on gold because obviously we've seen its rapid ascent and kind of the idea why. And I would agree that, gold, you could argue, is speculative. It's not paying a dividend. It's what the market's telling you what it's worth. I want to touch on what you said about just the amount of money that's flowing around, and you're seeing these pockets, these little bubbles. And obviously, I would allude that to when people bring up the R word, recession. Well, not all recessions are cut the same. It depends on how long and how deep. When we talk about these bubbles, I think what most people are, they're leaning on historical context, maybe like the .com bubble or the great financial crisis. Do you think that it's fair, or is that just more human nature? And then what bubbles are you are there any bubbles that are keeping you up at night, or are you just looking at this as well? This is just a dynamic or a potential fallout if we do eventually see it pop.
Well, I think there are some bubbles forming, and I think first of all, let's talk about where there may be some bubbles, but also what's causing them. So as I said, it's a pretty boring economy, kind of healthy tortoise, but it doesn't seem to justify a market that goes up 20% plus for 2 years in a row. It's now 15% higher so far this year. I mean, those are extraordinary numbers. In fact, if you go back to 1985, you go back for the last 40 years, we've averaged a 12% compound annual return on equities, which is just extraordinary. So these have, I do think the market's gone up a lot relative to the economy. Part of the reason, though, I think has to do with the structure of markets. So a problem is, and you probably you deal with this, with investors and clients all the time, is what do you do if you've got money in a non-taxable account and you've piled all this money in U.S. equities or maybe in a large cap growth fund or whatever, and it's sitting there, and you might think there's a bubble, but if you sell it now, you know for certain you have to write a big check to Uncle Sam, and then you got to figure out how to invest it. So it's really hard to get out, to make that decision to get out. And, because of the way our capital gains tax law is written, if eventually down the road, hopefully long time from now, but you pass it on to your heirs, so it'll be a step up in basis, and they won't have to pay the tax, and nobody pay the tax. So I think that's keeping money in the market. I think there's also a lot of automatic 401k money. It used to be defined benefit plans, and they were forced to rebalance, and now it's all 401k money. It just flows straight into the equity market. So it's kind of like a stuck valve. The money can get in, it just can't get out. And I think that's part of what's creating this. And of course, I think when you have very low interest rates for a long time, as we did, I think that's only just adding fuel to the fire. So I think that's kind of what's creating these bubbles. It's not the idea that we're approaching some sort of economic nirvana, which is going to splurge profits at us forevermore. It's just, there's no way out.
I don't disagree. It's more around the logistics of it than just this existential crisis that's coming down the pike. And I think when it comes to risks, it's the risk that you don't see is the biggest concern.
Yeah.
I want to talk about international. We look historically international investments, and I think I was listening to your take maybe about a year ago, and I think you called it. You said, "Hey, there's pockets that international emerging markets that are undervalued compared to the U.S." And we're obviously seeing outperformance in international investments this year. Do you think that continues?
I think it could. What I will say is these tend to be very long cycles, and we saw the U.S. beat international equities basically from 2008. To 2022, almost every year. And then suddenly the dollar peaks, and the dollar is down about 10% year to date. And that amplifies return on international investments. And so I was just looking this morning, EM equities in US dollar terms are up about 30% total return year to date. And other developed countries are up about 26% year to date. And the US 15% is an amazing return, but it's still being trounced by international this year. I think it could continue because even after that, since we've had a long period of underperformance, US stocks still look expensive relative to international. I mean, international stocks selling at a 15 or 16 times earnings, US stocks selling at 23 times earnings. So US stocks are significantly more expensive, and the dollar is also overvalued, and you know that because we run a big trade deficit because our stuff's too expensive and everybody else's stuff is too cheap. The tariffs may affect that a little bit, but I think it'll still be a big deficit. It tends to push the dollar down, and if the dollar falls, the more, and it is the reason you get these long cycles is the more the dollar falls, the more people are going to look at their statement at the end of the year and say, wow, my European stocks are up 30%. Wait, did I have any European stocks? No. Darn. Well, let's get some European stocks. And so, when I talk to financial advisors around the country, almost nobody is overweight international. Virtually nobody. And certainly that was the case at the start of the year. And so if everybody's crowding one side of the ship, and then the other side starts doing better, you can sort of see a lot of money could flow that way. And of course, US investor money buying international stocks, well, guess what? That pushes up international stocks.
That's right. Yeah. And I would blame that just on that overweight concept right there, which is in the fact that it takes so long for those economic cycles to go through that for the majority of the time, yeah, it was right. We were better off in U.S. equities than we were in these emerging markets. The problem is missing those markets, and that's why we do generally have that perception. And our message to our listeners is that you've got to participate in some way. When it comes to global markets, do you have any economic favorite zones, anything that you'd like to talk about, areas, countries?
Yeah, well, for the most part, the country, the valuations that you see in countries kind of reflect some of their issues. So India is obviously a booming economy, but Indian stocks are notoriously expensive. The UK economy is kind of stuck in the mud as it's been for a while, but UK stocks are very cheap. I would say, I kind of like Eurozone stocks because I think the Germans are determined to spend more money on defense, and I think there's a fiscal push. So despite sort of the usual craziness in Paris with their government, I do think that the Eurozone economy is doing pretty well. I think we'll get better, and I think Eurozone stocks will benefit from that. Also, it sounds a little out of the way, but there are certain regions which are not getting hit by the trade war as much. I put sort of South America, Latin America, South America in particular, but also even Mexico, and also Australia in that camp where I think they can prosper despite the tariffs, and I think that there's some opportunities there too. But I don't think you have to be too cute about it. I think you just ask yourself, should the U.S. is now 65% of the entire global stock market, which is incredible. I mean, we're only 5% of the population. We're 65% of the global stock market, but how many people have 35% of their stocks in international equities? And the answer is almost nobody.
Yeah,
And so I think Americans can safely up their international allocation just broadly. I think that's a reasonable bet to make, and they don't have to worry too much about which region.
Speaking of the US, obviously what's top of mind for investors, government shutdown. Up until this point, it seems as if the market has just taken this right in stride, largely looking past it. Does that continue? Do we reach a point where investors really start to pay attention to this and start to recalibrate based on this government shutdown? Or is it a big nothing burger?
I wouldn't say it's a nothing burger because there are few problems with it. One, it is happening at a bad time because this economy was already going to go into soft patch in the fourth quarter because of tariffs. I think we're going to get a big income tax refund season early next year. I think that's going to help the economy rebound a bit. But the next 3 months are going to be pretty lean, and it does not help that you've got a government shutdown occurring at a time where there's going to be a lot of federal government layoffs anyway. You've got, there's no electric vehicle tax credit anymore, so and consumers may be pulling back. So it doesn't happen. It's not happening at a good time. The second thing is that we're losing visibility on some key issues at a very important time because we didn't have a jobs report last Friday, and I don't think we're going to get a CPI report next week. And I really want to know what's this turnaround in immigration policy? What's that doing to labor supply? I mean, we got a very weak jobs report for August. And I really want to know, is it really dragging unemployment, going forward? So I think that's important. And then also on inflation, we need to know, eventually the Walmarts and the Home Depots of the world are going to pass on these tariffs to consumers, but we don't want to know how fast that's going to take. So I don't think it's a nothing burger. I think it's a growing problem. The longer it goes, the more of a problem it's going to be. But on the other hand, I wouldn't mind to see the markets actually. It would actually be very healthy if the market suddenly got very scared about it because nothing wakes up Washington more than a market crash. And so if the market was to fall rapidly, then suddenly Congress, senators and congressmen who didn't want to get the job done might feel differently.
Now, from the asset management standpoint, can we actually talk more about that with what JP Morgan is actually providing as tools? We had the advent of ETFs that happened, I believe, in the late 90s. That definitely changed a lot of things. We've got a lot of ETF blended funds, managed funds, things like that are available to the general investor. We're talking about now, we just come out of the topic of global investments and changing your allocation up there and adjusting things there. Do you believe that there are good solutions within managed funds for people to gain some confidence as far as their 401ks go? I think a lot of people are feeling helpless right now. Where do you generally suggest people to go? Where do you learn? What do they do to make things better?
I think first of all, in terms of types of vehicles, we've certainly seen a lot of growth in ETFs. I'm not going to talk about any particular ETF fund, but they are a very efficient way of getting access to markets. I think we tend to specialize in active ETFs. So what we do is we use active portfolio management to try to not buy the stuff that we think is outrageously overpriced and increase our weights and stuff that we think makes a lot of sense. So we do use active management, but it's much more efficient than from a tax perspective. They're just the way it's built. You tend to see much fewer realized capital gains, so that helps a bit. And then we sort of have daily liquidity, which or it's a little easier to get exactly what you want or withdraw exactly what you want from an ETF at market prices. So I think that the industry is moving a little bit more that direction. We still absolutely have traditional actively managed funds. I think that there is a lot to be said from being actively managed right now, because the problem is so many people, if you invest passively, then you are basically buying into whatever distortions are in the market. And I think that, as we talked about, in terms of industry concentration, as those biggest companies, as biggest tech companies become a bigger and bigger and bigger part of the S&P 500. If you're just buying an S&P 500 index fund that's not actively managed, you're kind of overweight the stuff that we're most concerned about.
In your opinion, what could derail this? I was looking at the guide to the markets, and there was an interesting page. I forget the title of it, but it was going back historically, I think, to the 85, 95, 2005, 2015, and here we are, 2025. And it was representative of what the largest companies, I think it was the 10, maybe it was the 5 largest or 10 largest by market capitalization. And even just maybe 15 years ago, we're not seeing those same companies in that list, that lineup anymore. Obviously, you've been this in for decades and decades. You've seen that transition. Does this worry you, or is this just a part of the cycle, or the innovation of new companies, new technologies that just lead them to ascend to that level?
I think it means you should pay attention. It doesn't mean you should worry about it. I mean, it's. I think that the lesson of 1999 wasn't that you shouldn't invest in internet companies. It's you should be darn careful about which ones you invest in. There's some names, like Microsoft and Apple, that have completely stood the test of time and been tremendous long-term investments. And I'm not making any claim as to their value today, because that's not my job. But there are plenty of others, which like CMGI or JDS Uniphase or Pets.com, that disappeared into the ether, were never seen again. And so there will be distinct winners and losers from this AI boom also. And I love that page in the guide, because it shows just how much these names have changed, but also just even relative to previous episodes, just how much of the wealth of the stock market wealth of Americans is concentrated in this AI boom. And so it's just very important to figure out who the winners and losers in that space are going to be, and have really thoughtful asset managers who've been looking at these companies and companies like them for years, trying to figure out where the risk is here and where the opportunity is.
On that same note, so we're talking about publicly traded companies. We've seen a rapid ascent of non-publicly traded private investments, alternatives, if you will.
Yep.
And that number just stuck out to me of where we were years ago, of how many publicly traded companies that were available versus now. Compare that to private investments. How do you see that space? Is this something that you have to pay attention to? And is this a trend that we continue to see, where companies are less likely to IPO and become public? They just want to stay private, like an OpenAI or maybe SpaceX.
Yeah.
Well, yeah, there's a push and a pull in this. So ever since Sarbanes-Oxley and other types of regulatory layers of regulation, it's become more and more expensive to be a small publicly traded company. If you're a very big publicly traded company, I suppose you can afford to have an army of lawyers and accountants to get it all right. But there's definitely economies of scale in this, so it's much harder to be a publicly traded company. And at the same time, you've got a lot of investors who want to diversify away from public markets, and they want to put money into private equity or private credit. And so there's a pool of money available to people. And so if you're running a small business, or a medium-sized business, obviously, if we're talking about investing in it as a public, there is an option to you. We're not going to do an IPO. We're just going to grow this business in private hands here. We'll make more money this way. And it seems like there's plenty of private credit available. There's private equity available. We just don't need to go that route. So I think it's easier for a lot of companies to stay private longer. And that's what we're seeing. It takes a lot longer for something to go to an IPO or to be publicly traded, and a lot of companies just never do it. So yes, I do think it's something for investors to think about. I think you've got to be very careful about the manager you use, because in big public markets, like people who are in large cap stocks, a good manager is not much better than a bad manager, because they all kind of hug the benchmark. But when it comes to private equity, there are some really good managers and some really bad managers. And so I think that's something you've got to look at. But then there are other things. We have a guide to alternatives. We have a guide to the markets, which we use to try to talk about markets in general. But we have a guide to alternatives also. And I talk to sort of alternative managers, people who manage infrastructure, so that you can invest in companies that just provide private water and power to localities, or you could invest in transportation. We actually own a lot of ships, And that's a very interesting business too, because it's oddly enough a geopolitical hedge. If if there's somebody shuts down the Strait of Hormuz or something like that, then or the Panama Canal, you've got to send the ships around longer, so you actually need more ships. So but they've all got their strange niches. But generally, yeah, I think we're looking for sources of diversification, and so long as you do it right, and I think this is particularly true for wealthier investors, it makes sense to have some alternatives in the portfolio, so long as you're using good people to run the money.
I think usually the risk associated with it from an advisor standpoint is we look at liquidity and also, how visible is it? How well can we see into it? Do we have clarity into how that one is going to function? What we really want to express to people is just do your research, hire credible people, interview them, do the research. But it should be a good mixture within an allocation as long as you have the goals and the time and the risk tolerance, the whole bit. But to evaluate them. But yes, you're definitely proving the point. I believe that, a perfect example right now of a conflict between a publicly traded company choice and being private would be what Elon Musk is doing with Tesla and with SpaceX. One, he can't do anything right, and he's got to explain everything he's done to the shareholders. The other one, he just does what he wants. In fact, I think he's shooting off another rocket here next Tuesday or something, another big one. And it's a lot easier for him that way.
Well, it is, and of course, this is the unintended consequences of regulation. I don't, I believe that we need regulation, and I think and in many ways, when we enter a world of AI or the ability to use social media to impact how people think about the world, in a lot of areas we actually need more regulation, but we need smarter regulation. And the problem is that we tend to just, apply a sort of politically vindictive regulation on certain companies and industries, and people say, I don't want to deal with it. And so we've got to take the politics out of regulation and try to be innovative and intelligent and update regulation and make it as non-onerous as possible, while still being very aware of the potential risks that can occur if you don't do the regulation at all.
Well, I think you're right. I mean, when it comes to the private space, I mean, the transparency isn't necessarily there. Or you could argue on the public side, there's just a gluttony of information and how do you parse through it? But to your point about the manager side, them hugging the benchmark, it's like you really don't have that level of dispersion where you could have a private alternative investment just go to nil and you had no idea along the way. You thought it was a darling sweetheart. I want to get into, Dr. Kill, your take on what you're optimistic about and maybe what you're worried about. Is there anything, I mean, I'm sure you're parsing through so much data. You've probably forgotten more information data that I've actually been exposed to. So I'd love to just get, even if this is more anecdotal, but is there any big risk or like anything that's keeping you up at night, or if there were something to keep you up at night from the economy, from an investment standpoint, is there anything that you have top of mind in that regard?
Well, it's usually people ask me, what keeps me, wakes me up at night rather than what allows me to sleep soundly. You know, look, we've got a good economy. It's grown for many, many years. We are so much richer than our grandparents or their grandparents, so, in a way that they would utterly not recognize the lifestyles we lead. And we take a lot of that for granted. We've had, what do I get excited about? I get excited by biotechnology. I mean, the incredible ability for us to create medicines by reading and exploiting the human genome. It's amazing. And we've got some of the smartest people in the world are working on how to help humans live longer and better lives by exploiting things about our biology, which are just mind-blowing. These are exciting things. I think, AI has got a lot of potential. I think robotics have got a lot of potential to make the economy better too. So there's a lot of, I feel very good about the capability of a technology to be a tool for good. Mm-hmm. And I also feel very good about the innate kindness and generosity of humans and their ingenuity. I mean, I'm very fortunate to run a team of 30 people around the world, and one of the things that makes me optimistic every day is just watching them work together and work as smart, work positively. There's lots to be positive about. What I worry about is usually not about the big picture. It's not about the global economy, or certainly not about global markets. I worry about individuals. I worry that individuals can, are prey to too much optimism or too much pessimism, or oddly enough, both at the same time. I mean, people who keep, salt all their money away in cash, but then buy lottery tickets or Bitcoin. And the easy way is to bet on the forest, bet on the overall global economy, make some reasonable tweaks, but don't you don't have to go to either an all or nothing strategy. And I see people who do both. I worry about the impact of social media on people's brains. And I want, best investment advice I could give anybody is, take your smartphone and get a jug of water and put it in it. It will,
And then drink the water.
it will improve your investment decisions. It will have a great side impact on improving your life too. So
I'm going to guess, Dr. Kelly, we probably all agree, is the volatility that we have that's just associated with political comments. It doesn't matter if it's from the left or the right, and the amount of control and impact it can have on market reactions and economics. Meaning, we seem to be one pivot away from disaster, whether it's the tariff talk or one comment or maybe something not well thought out. And this happened in the last administration. It's happening in this administration. I'm not blaming either other than the voters were actually putting these people there and causing a lot of the strife, just waiting for the middle to come back. I don't know where they are. Come back.
Well, I think there's some truth to that, but also remember that we don't have a Walter Cronkite.
Yeah.
We don't, it used to, when I arrived in America, you could basically, if you want to get the news, you'd watch ABC or CBS or NBC. So you get Tom Brokaw or Dan Rather or Peter Jennings, and they'd read the same news from straight down the middle every night. And it was kind of boring, but you kind of knew where you were. And now you've got people, if people they watch news at all, it's some cable channel where they're screaming some disaster at you from one side or the other, and you've got a social media algorithm which figures out what you're most scared of and just feeds you that all the time. And so I'll add, I do think a water jug is the best thing for a smartphone, and then generally speaking, if all you're going to do is watch the news all day on TV, then a baseball bat could fix that. And seriously, it's not, the economy is not a disaster. The economy is, we've got 4.3% unemployment, we've got 2.9% CPI inflation. Historically, those aren't bad numbers. It's okay.
I guess my reference might be more from the point, let's just look at Trump administration in April announces tariffs. The market just craters over that. Meaning there's a lot of control going on. If you talk about inflation, Federal Reserve, executive orders, which has been a trend for the last 4 administrations. And so I'm including everybody on this one, which is we've had a lot of political volatility and it needs to get better. But my concern is that I'm concerned, if you ask me what my concerns are, my concern is how much the politics right now is having an effect on people, which may even be exacerbated through social media, et cetera.
Well, I do think that's, I don't know the answer to that. I do know the answer to it, I think, but I don't know that we'll ever implement it. The reason we have got bad government is because we've got bad elections.
Yep.
I come from Ireland, where we use a proportional representation system, and I'm not going to go into all the details of it, but basically it means that you end up with a lot of moderate politicians who have to appeal to people across the divide. We end up with relatively intelligent governments who do the right thing for the most part for the public. The public complains about them, but they deal with things in a civilized way, and it's just such a better system than our system, which just builds polarization. The electoral college, as just one example, we shouldn't have blue states and red states. There's absolutely no reason for it at all. If voters in your state and voters in my state don't really get it, we don't have any choice in the election, because what we do doesn't matter at all, because our state is always going to vote one way or the other, and it's just it's not a good way to run elections. But I think if you want to fix polarization in America, it's not the people, it's not even the character of the people we put in Congress or the character of the voters. It's that we've developed a system under the U.S. Constitution which actively divides us, and we ought to think about trying to devise a political system which might unite us.
Dr.
Yep.
David Kelly, you've touched on this a couple times throughout this conversation. You brought up robotics. I want
Yeah.
to dive, obviously, we're not going to talk about specific companies, but where do you see this development and increasing of use of robotics? Like, what industries are leaning more towards that? Like, what sectors are putting more money into this? Because you hear Elon Musk talk about the humanoid robot, that this could potentially be the next iPhone moment as far as a piece of hardware that people will own these in their house, and it's going to be a $20,000 to $30,000 thing. And I certainly, in my opinion, my humble opinion, I do think there's something to that. But obviously, there's a grander scale when you talk about the inclusion of AI and robotics. Where are you seeing robotics right now? When does that trend really start to accelerate, or are we already there?
Well, I think it's accelerating. I mean, first of all, it's already accelerating U.S. manufacturing. So, even if we were able to bring all the factories back to America, we wouldn't bring the factory jobs because they're all going to be done by robots if we're going to be competitive globally. But also, I see, China is investing a fortune into robotics, and Japan has been in robotics for a very long time. And you can see, I mean, I'm not just talking about humanoid robotics. I mean, there are lots of intermediate steps.
Right.
There are a lot of little jobs that, for example, in a warehouse, you don't necessarily need to have things that look like humans move stuff around. You can just find just a little machine does this, a little machine does that, and maybe you put on a better GPS system on, and suddenly it knows how to get from point A to point B, or maybe its tactile sense just gets a little bit better. But also, self-driving vehicles is growing. You can see that being tried out in various cities around America, and it's going to grow. And right now the problem is the interaction of humans with these self-driving vehicles, but they'll get better over time. And the problem, one of the interesting things is around the developed world, we've got a declining birth rate, and we've got a working age population aging into retirement.
Mhm.
And so as the number of workers falls, the need for a combination of some form of technology or artificial intelligence or robotics will grow. If you just can't afford for somebody you can't find anybody to mow your lawn, well, maybe you do have some sort of robotic lawnmower go around and do the job for you, and so on. I think that this will grow over time organically. It's one of those things in economics where at each point, there's come a point in each of these little jobs where, okay, it actually does make sense to use a robot to do this. It's going to cost a little bit more money, but they'll pay for themselves in 3 years or whatever. And that's, I think it's going to gradually occur over time, but it's going to be powerful. And it's going to be powerful in terms of productivity measures because right now AI can do a lot of transformations to paperwork or make a more beautiful picture or something, but these aren't having a huge productivity
Right.
impact. But as you actually say, this job can be done. We can take 100 people here, or we can have 10 people and a robotic installation which is going to do this job. That's going to have a real impact on productivity.
We've had great examples of this in the past as well, with just the idea of a personal computer. When it passed its entertainment phase and actually had utility, it became something that you would want integrated into households. And consumers will get a hold of the robotics, I believe, when the entertainment is not the primary attractiveness of that unit. I mean, they're just going to have some, hey, it does the dishes for you.
Well, exactly. And so I mean, if you ever watch Mad Men and
Yep.
look at all the secretaries in the 1960s office and 50s, where are all the secretaries? They're all
Yep.
gone
That's right.
because with personal computers, it really doesn't make any sense, does it?
Mm. I'm so optimistic about our technologies and what's coming around AI, robotics, rocketry, the whole bit. I think there's a lot of opportunity and something that shouldn't be ignored. We want to really just thank you right now for being a fantastic interview on our program, The Real Money Pros. We feel super lucky to be able to have you on. Dr. David Kelly, Chief Global Strategist, JP Morgan Asset Management. Thanks again so much for joining me, Jeremiah, and all of our listeners.
Well, this has been a lot of fun. Thank you very much for having me on your show.
Well, we appreciate it as well.
Thank you, Dr. Kelly.